What's going on, guys? I want to show you an easy chart pattern to identify if you guys trade futures, options, stocks, equities, whatever it is that you trade, right? Forex doesn't really matter. What we're looking at here, what we're going to focus on as futures day traders is the NQ chart. We're looking at the 5-minute time frame. Also, guys, by the way, Apex 80% off sale ends today. You can use my discount code DAnthony. But I want to show you guys this chart pattern here. A little bit of a flag along with a 20 SMA. Okay, so if you guys follow this channel, you guys are inside of Evolution Traders, you guys already know what the 20 SMA trade is. If you don't, I've got over 2,000 videos here, and probably half of them are talking about the 20 SMA setup. But one thing that I want us to focus on here is if you look at this chart, you're going to notice there's a lot of moving averages that are on the top side, right? So notice all of this congestion. These are all different various moving averages. This is telling us that the pressure is down, okay? And why is the pressure down? Well, you're below supply. And when you're below supply, each one of these moving averages is going to act as a level of resistance. So if you start correlating that with candles closing below or over the 20 SMA for an intraday trade, you're going to start to get some very, very good results. If you start pairing that with other patterns in the market, like, so for example, look at the low that we put in here at 9:10 a.m. Pacific Standard Time. Okay, we put in a low where we kind of swept all of this consolidation, right? So we consolidated for the better half of about an hour and a half, almost 2 hours. We put in this low, we started to chop up, we started to bounce. You could see here we put in a higher low wick that never took out this low. So that starts to get me very, very interested because, one, if we don't take out the low, there's a potential that the market dead cat bounces, okay? If we do take out this swing low, there's a very good potential that the market's going to go down further. So now I've got a two-sided trade opportunity, and all I realistically need to do is wait for one of the two to happen. And if you look at where this market continues to bounce, it bounces into the 20 SMA. Now, I don't want to go long on this 20 SMA, and here's the reason why. Because in the market, I got to take a moment here. The market is absolutely dumping here. We're down 217 points. So making this video live, market is absolutely dumping. I don't want to go long in this particular situation because we are still below a lot of supply. Now, this is a 5-minute time frame. If the market's going to dead cat bounce and it's going to get stronger, I need to see it reclaim some levels. And in order for us to reclaim some levels and for me to want to get long 24,990, it's got to get over that, right? So it's a long ways away from doing that. So we're going to ignore these long setups, ignore this long setup, ignore this long setup until you reclaim supply. All of these bounces are areas of opportunity for you to get a better price on your short. And it's for you to get a better price on managing your risk by putting a good stop loss over those rejections into supply. So if you look at this trade here, the setup that sets up at 9:50 Pacific Standard Time, this candle closes below the 20 SMA. So you guys already know all we're waiting for is a following candle to confirm the low. But one second. If we pair that, because the market was choppy, there's no real way to identify at this particular time, right? At this particular time that the market's going to do this. So we can actually pair this and say, okay, if the most recent swing low, if we take a trend line and we draw that up to the following wick swing low, and we kind of make this quote unquote bear flag, well, if we get below the 20 SMA, that's telling us we need to be short. And if we actually break the prior swing low, which at this case was low of day, we can enter into this trade. And because we have so much supply ahead, we've got a ton of areas that we can use as potential stop losses. So for example, you can take this trade in one of two ways. When we break this bear flag, it's an active 20 SMA, you can jump in here. Or you could do what I like to do a lot of the times, probably about 75% of times, and I do what's called a second entry. You've got a level you're looking to go short, allow it to break that level. That's step one. Step two is entry when we confirm the level that was just broken. Now in this particular instance, we can use that candle's high, right here, as the stop loss. It's also correlating with reclaiming the 5, 10, and 20-day moving averages. So if we did bounce, I don't want to be short if we're over the 5, 10, and 20-day moving averages anyways. I would want to be long, so to speak. So it's setting you up for a perfect area of opportunity to go short while managing your risk. So how much is your risk? What are you risking on this trade? Well, this particular candle is 21.75 points. So you could essentially risk 22 points on this trade and at least target a 1-to-1. Okay. Now, if you're a quick in and out guy, you're a quick in and out girl where you want to get in as fast as possible, get out as fast as possible, we'll take the overall risk, 22 points, and kind of divide that. So if you go for half that range, you're looking for 10 to 12 points. Get in, get your 10 to 12 points, get out, walk away, close up your screens. Don't get any FOMO. Don't worry about all this. Because again, we don't know that it's going to do this. There's a potential. Look at the linear regression down here. We did come down to the linear regression. We did sweep it. There's a potential, but it's never a guarantee, right? So if you take the candle and use that as a 1-to-1, well, then you would be looking to at least target 20 to 22 points, and you could always move your stop loss to break even and then just kind of hold a runner. Maybe if you're trading 5 micros, sell out of 3 of them and then hold 2 as a runner, and as long as that stop loss doesn't get hit, you can try to hold every 5-minute candle closure, try to kind of inch your stop loss a little bit way down. So the strategy that I want you guys to use is compare and contrast 20 SMAs with bull and bear flags. Put those two together to give you double confidence and double confluence. So not only do we have a 20 SMA here, we also had the bear flag. So if those two check boxes get checked, then we can take the trade. Instead of just trying to take the 20 SMA, instead of just trying to take the bear flag, you can say, okay, well, not only is this a bear flag, it's also an active 20 SMA trade, and there's a lot of supply ahead of me, so I can go ahead and go short. I hope you guys found something out of this video. Hope you guys can use it. Also, if you guys want to use a moving average as a power trend, meaning you are absolutely not going against a trend if you're trading below a certain level, use the 5 simple moving average. That's the green line here. In this particular case, we have been power trending below the 5 simple moving average. I'm not looking to bounce here. 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 I'm only looking to bounce if we reclaim the 5 SMA off after an extended down move. This will keep you safe. This will keep you on the right side of the trade. Never, ever, 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 ever go against the 5 SMA. If the market is pushing down, make sure you are never going against a trade. See you guys all in the next video.